Hello, everyone. My name is Terence Vanderwood, co-host of Dollars with Sense radio show and podcast, here with my fellow guru, Ela Lange.
Hi there, Terence, and hello, everyone. Thanks for joining us. Comprehensive financial planning is our passion, and helping people grow and protect their wealth is our mission. Today, we'd like to help explain the recent changes to the mortgage rules announced by the Department of Finance earlier this month. These new regulations are aimed at protecting the financial security of Canadians and supporting the long-term stability of the housing market in Canada. What those new regulations are and how it will affect you is the topic of today's episode of Dollars with Sense.
That's right. For the next 20 minutes, we're going to present you with answers to questions you may have around the new regulatory changes, as well as look at the fundamental elements within the mortgage industry, such as the Canadian Mortgage and Housing Corporation, the CMHC, which you may have heard of, insured versus non-insured mortgages, and high versus low ratio mortgages, among other things. This episode should especially be of interest to first-time homebuyers who are facing the biggest challenge of getting into the real estate market today here in the Lower Mainland. Finally, we will be referring to our favorite mortgage specialist, Michael Hallett, who provides us with his insight in a previous episode. We'll see what suggestions he has for you out there.
Let's jump right in. The Canadian Mortgage and Housing Corporation, also known as the CMHC, has been Canada's national housing agency for almost 70 years. They help Canadians meet their housing needs. As Canada's authority on housing, the CMHC contributes to the stability of the housing market and financial system. They provide support for Canadians in housing needs and offer objective housing research and information to Canadian governments, consumers, and the housing industry. They pride themselves on prudent risk management, strong corporate governance, and transparency.
The CMHC came out of the first two advisories aimed at clarifying new regulation rules. They distribute out the housing market assessment every quarter, providing us with the financial and mortgage industries a comprehensive view of indicators to assess house marketing conditions in several metropolitan areas across Canada. This framework allows a wide range of indicators on house markets to be captured in a single snapshot. The objective is to identify locations in which there is a heightened vulnerability to housing market stability from the level of house prices or from factors that are known to influence future house prices.
So in the most recent market assessment, the CMHC is raised its overall assessment for Canada from a low level of evidence of problematic conditions to moderate. Driving the increased level of evidence has been increasing growth in housing prices, which we're all very familiar with here in the Lower Mainland, that has pushed house prices to levels that exceed the fundamentals supporting the housing market. So these fundamental factors include changes in income and population. Prices have increased relative to fundamentals in Toronto and Vancouver and are increasing rapidly in some other parts of Ontario and British Columbia. This pattern is not reflected in many other provinces.
This was the driving force behind the new regulations. Our favorite mortgage expert, Michael Hallett, summarizes the changes in his recent blog. And the link is coming up on your screen now, so you'll be able to check it out for yourself. We, as borrowers with less than 20% down, will qualify for less available financing from the lenders. All mortgages, regardless of the term, 6 months to 10 years, or type, either fixed or variable, the mortgage will be subject to the same stress test. The qualifying rate that will be used going forward as the Bank of Canada 5-year benchmark rate is an interest rate of 4.64%.
So that's perfect. That sums it up really very well. Before we move on, we should clarify that the new mortgage rate stress test, as we mentioned before, does not apply to existing mortgage applications before October 17th, 2016, as opposed to the original date of October 3rd, 2016. The original transition period, as stated, with a funding date of March the 1st, 2017, no longer applies.
Let's briefly outline the difference between the insured mortgage, or high ratio, versus non-insured mortgage, or conventional and low ratio. An insured mortgage is when a home buyer has less than 20% down payment on the mortgage, and the mortgage is insured by either Canada Mortgage and Housing Corporation, or CMHC, Genworth, or Canadian Guarantee. The insurance premium is passed on to the borrower. This insurance provides security to the lender in the event of a home buyer default. A non-insured mortgage is when the home buyer has 20% or more for a down payment and therefore is not required to pay mortgage insurance. Currently, insured mortgages with a term of less than 5 years and or a variable rate mortgage had to qualify on the Bank of Canada or the BOC rate.
Now, for the update. This requirement will also be extended to low-ratio mortgage-insured mortgages, effective November 30th, 2016. Under the new Department of Finance regulations, all insured mortgages, regardless of term, fixed or variable, will now have to qualify on the BOC rate. That's that Bank of Canada rate.
So say there's a property that's which is a single unit that will be owner-occupied. The maximum amortization, or the number of years that the mortgage can be paid off, is 25 years. The maximum property purchase price of or below $1 million, minus 1 cent. Minimum credit score of 600. You can refer to a previous episode on our YouTube channel. Just go to the YouTube search bar and type in Ela and Terence, and up will come all of our 30-plus episodes that we have on our YouTube channel. And you can click on them. Probably the best one to click on is Dollars and Divorce, where we talk about the credit score. If you have any questions, other questions around credit scores, or any other financial questions, please feel free to contact us either by leaving a comment on the YouTube channel or on our Facebook page of Dollars with Sense. You can leave a comment there. You can contact us via email at twofinancialgurus@gmail.com. That's the number 2financialgurus@gmail.com. Or you can give us a call. You will be guaranteed to have a lovely voice at the end of it, of the number 778-879-0820. Thank you, Ella. Anyways, back to where we were. So minimum credit score of 600. To qualify for mortgage insurance, a home buyer must have a gross debt service ratio no greater than 39%, and a total debt service, or TDS, ratio no greater than 44%, calculated by using the Bank of Canada's conventional 5-year fixed post rate, which is now 4.64%. So a gross debt service, or GDS ratio, is the carrying cost of the home, including the mortgage payment and the taxes and heating cost, and is measured against the home buyer's income. Total debt service ratio is the carrying cost of the home, as mentioned before, and all other debt payments, and measured against the home buyer's income. So there's some definitions for you.
How does this affect a home buyer with less than 20% down payment? The biggest effect will be on the amount that the home buyer will be able to qualify for. Previously, the 5-year fixed qualified at the lender contract rate. Now, the home buyer must qualify at the Bank of Canada rate. Previously, for example, a 5-year fixed mortgage at 2.39% rate was qualified at a 2.39 rate. Under the new rules, a 5-year fixed rate mortgage at 2.39% must be stress tested by qualifying at the Bank of Canada posted rate, which, as we said, is currently 4.64%. The net result is an approximate 20% reduction in the amount of mortgage money available. For those counting on putting more than 20% down, there obviously is no significant impact anticipated.
To place this into perspective, in 2008, fixed rates were 5.99%. This is still much higher than the current qualifying rate of 4.64%. Interest rates that borrowers will actually get are still expected to remain near record lows. So that's good news. So here is another aspect of what the lenders are looking for from you, the borrower. Are all lenders affected equally by the new regulations? While some lenders take out insurance on all of their mortgages regardless of whether they are high ratio or not, under the new regulations, brokers may need to work with lenders that do not insure all of their mortgages in order to help home buyers qualify. A qualifying rate is the Bank of Canada conventional 5-year fixed posted rate, like we said before. A contract rate is the rate offered by the lender on the home buyer's actual mortgage payments.
Lenders have the option to purchase mortgage insurance for home buyers who make a down payment of at least 20% or more of the value of the property. These mortgages are known as conventional or low ratio mortgages. It's generally because the loan amounts are relatively low in relation to the value of the subject property. There are two types of low ratio mortgage insurances. Transactional insurance on the individual mortgages at the point of origination, which are typically paid by the borrower, as well as the portfolio or bulk pooled insurance that is acquired after origination and typically paid for by the lender.
Effective November 30th this year, 2016, mortgage loans that lenders insure using discretionary low loan-to-value ratio mortgage insurance must meet the eligibility criteria that previously only applied to high-ratio insurance mortgages. New criteria for low-ratio mortgages to be insured will include the following requirements: a loan whose purpose includes the purchase of a property or subsequent renewal of such a loan. A maximum amortization length of 25 years, a maximum property purchase price of below $1 million at the time the loan is approved, and for variable rate mortgages that allow fluctuations in the amortization period, loan payments that are recalculated at least once every 5 years to conform with the original amortization schedule.
Also, part of the new criteria for low ratio mortgages will be a minimum credit score of 600 at the time the loan is approved. So we've discussed that already. And a maximum gross debt service ratio of 39% and a maximum total debt service ratio of 44% at the time the loan is approved. That's calculated by applying the greater of the mortgage contract rate or the Bank of Canada conventional 5-year fixed posted rate. Finally, a property that will be owner occupied. Very important.
So those are the 7 new criteria that's come to us this year. So what does this all mean? Here's an example of how it will affect borrowers going forward. A client with an annual income of, say, $100,000, no monthly debt, great credit, buying a strata home can utilize today's lending criteria and qualify for $625,000 purchase with 10% down and a starting mortgage balance of $576,000. Once the new rules are in place, that same client will only qualify for $510,000 purchase price. So the difference there is $66,000 less worth of house that one can buy. Now that the new rules are in place, that same client will only qualify for $510,000 purchase price. These new qualifying rules are likely to decrease the purchasing power of all high ratio mortgagors by 20 to 25% across Canada. For borrowers to qualify for mortgage insurance, their debt servicing ratio must be no higher than the maximum allowable levels when calculated using the greater of the contract rate or the Bank of Canada posted rate. Lenders and mortgage insurers assess 2 key debt servicing ratios, as we've discussed, to determine if a home buyer qualifies for an insured mortgage.
So there's a whole bunch of new details that may prevent you, the listener, from moving forward to be pre-approved for whatever your needs may be, and to get pre-approved again with the stress test factor included. Here's your action item for this week. Your 2 financial gurus, Terence and I, recommend for you, especially the new home buyer, that you start the conversation to perhaps either increase down payment or start the process of looking for a new home within your new imposed budget. We have a mortgage specialist on our team here at Investors Group who can help you with your ratios to secure funding for your possible next major purchase or refinancing. So the action item for everybody is to get pre-approved for the mortgage you need and want.
That is a very doable action item. Thank you for that, Ella. And if you have any questions around that and find it not doable for yourself, you can contact us via email at 2financialgurus@gmail.com. That's the number 2financialgurus@gmail.com. You can give us a call at 778-879-0820. You can also visit us on Facebook, on our Facebook page called Dollars with Sense, where you'll find all the episodes and the transcripts of the 30-plus episodes that we have on financial planning. And finally, you can listen to this and those other episodes of Dollars with Sense on our YouTube channel. Just type in Ella and Terence into the YouTube search bar, and give us your comments.
Thanks, everybody, and it's certainly our team over at 98.7 The Point who help us bring this information week after week to you, our listeners. And for your time and attention, Terence and I, your 2 financial gurus, ask you to not keep us a secret. Pass on the good word and incredible knowledge to those in your circles that will benefit from this introduction and knowledge. We actually have an ongoing contest that you'll see pop up on your screen right now for an amazing trip to Brazil. All you need to do is refer a friend to sit down with Terence and I at no cost, no obligation, and we can set you up with a financial review. You can check us out. You can check out those price details at the Investors Group YouTube channel. So I'll put that up on the screen right now, too. So on behalf of Terence and myself, I have a great week, everyone. And may your dollars and cents be with you.